There's options all the way to a zero down payment program.
Hello, everybody. Dave Barlow here with Sell for 1%. Got Rich Sircone with Equitable Finance and Junior Meister Jaime with us here this morning. And Jaime, you work a lot with buyers. And Rich, this morning we're going to talk about the multitude of different down payment that's abilities for buyers to use. And so we're just going to jump right into this and tell us a little bit more about the different options that a buyer has for down payment.
Yeah, Dave, this would be more geared towards the person entering the market, the quote-unquote first-time home buyer, or even somebody who maybe has not accumulated a lot of money for down payment, and they're thinking, can I get into the market? Is this, are there options for me? And yes, there are. There's options all the way to a zero down payment program that a person could conceivably do. And so we have no money down programs that are through what's called the Ohio Housing Finance Agency, OFA. And you can get an OFA loan and no money down. Typically what it is a first and a second mortgage, and the second mortgage is typically forgivable after 10 years. So you have a first mortgage and your down payment would be the second mortgage, taking you all the way to 102% loan to value, which allows you to then to finance in your closing costs and literally come to closing with less than $100 out of pocket. Yep. So that is one program. Income limits on that program are $112,000 in Central Ohio, and it's a good program. And the lenders like myself and other lenders all have their own in-house zero down programs. But I'll say this about all the zero down programs: the rate is going to be higher, the cost is going to be higher typically on those programs. So anybody who can afford some down payment, you are better off to walk away from that free money and take a better loan either through FHA or conventional. So would you like to talk about FHA and conventional and what the different options are there?
Sure. Yeah, let's hit them all.
Okay, so FHA would typically be what most people think of as a lower money down program. The minimum down payment for FHA is 3.5%. So on a $300,000 loan, that would be a little over $10,000 down, and you can get yourself into a $300,000 home. So FHA, 3.5%. And the best feature about FHA is they accept a little bit of banged up credit. So if you've had some late payments in your past, maybe even if you've had a bankruptcy that you've recovered from a couple of years now, FHA is more liberal about credit hiccups that you may have had in the past. It's best for somebody like that with a credit scenario that maybe has been a little bit less than perfect. The great thing about FHA is the 3.5% down. The negative about FHA is there's a lot of cost also in this loan. You have something called upfront mortgage insurance. Upfront mortgage insurance is 1.75% of the loan amount. So on a $300,000 loan, you're looking at over $5,000 in upfront mortgage insurance that you have to pay. And that mortgage insurance can be financed into the loan, but a buyer has to be cognizant of the fact that they've got this upfront mortgage insurance that they're going to have to pay for. Even though it's financed in, it's going to be part of your payoff when you refinance or sell later on. So it's always important you understand that. And the other thing about FHA that's somewhat of a negative compared to conventional loans is the monthly mortgage insurance on conventional is called PMI, but in FHA it's called mortgage insurance. It's a 360-month, 30-year proposition. Your mortgage insurance in FHA never goes away. You always have the PMI or the mortgage insurance on a monthly basis. and it's a little higher typically than what the conventional monthly payment would be for mortgage insurance. But FHA, 3.5%. Banged up credit, probably the best product for you in that case. And the rates are great. They're 30-year fixed rates, so it's still a very good loan. Now, the next thing would be conventional loans. Conventional loans are Fannie Mae and Freddie Mac. Most people have heard of Fannie and Freddie. They are the two entities, the government-sponsored entities that buy conventional loans. And most people understand with conventional loans, you need 5% down. So a conventional buyer, you would need 5% down to buy a home under a conventional loan. However, there are options with conventional lending where you can do as little as 3% down on a purchase of a conventional house and get a great rate. And the 3% down program actually has a better rate and it has better PMI structure than what the 5% down program has. Those programs are called Home Ready and Home Possible. Home Ready and Home Possible have income limits as well, though. The income limits in Central Ohio on Home Ready and Home Possible are typically around $80,000 max income.
Okay.
And so that would be, if all things being equal, if you've got income of less than 80,000 and you're looking for a house in that 300 to 350 range or under, the conventional loan is going to be a fantastic option for you. Much better rate than the zero down program and much lower cost overall. That was a mouthful. I'm kind of out of breath there. Maybe you guys can ask me some questions. There's some color in the middle of all that.
I'm sure we have covered PMI multiple times, but for the layperson that this may be their first video getting into the market, what is PMI?
PMI stands for Private Mortgage Insurance. And what that is years ago when Dave and I were kids, they used to say you need 20% down to buy a home. And, until you save 20%, you couldn't buy a home. And that wasn't healthy for home ownership and for first-time home buyers. So they came up with that 5% down idea that you could buy a home with 5% down. However, the banks said, now, wait a minute, if we're going to give somebody a loan at 5% down, we want a little bit of assurance that if they default on the loan, that we can recoup some of our losses since we're not taking such a large down payment. So PMI came about for loans with less than 20% down. And I didn't mention this, so thanks for the questions. Conventional loans, the PMI drops off after you are under 80% loan to value. There's ways that you need to get that drop off, but it can drop off. As I said about FHA, it never drops off. You always have the monthly PMI on the FHA. They call it mortgage insurance.
Unless you refinance when you have 20%.
Unless you refinance, correct. If you refinance,
you may not want to refinance right now if you got a 3% loan.
Right. The people who've had an FHA loan at 3%, even though they are paying PMI, it's still a fantastic deal.
Sure.
Still a great deal. So, yeah.
But
so you'll hang on to that.
The advantage with FHA also is that they are assumable. So somebody's got a 3% rate, somebody could assume their 3% rate of whatever their balance is, and then take a loan for the difference.
Correct. You can assume FHA and VA loans.
Yeah.
So that is a definite feature right now with the rates being much higher. If you have an FHA loan and you want to sell, talk to Dave and Jaime.
Give us a call. Yep.
Yeah, and they can kind of walk you through the process of having someone assume that loan. It's a long process from what I understand, but it is possible.
Yeah, I mean, you have to apply just like you would for a normal loan to assume it. And yeah, I think it does take a couple extra weeks to go through that process. But the difference between a 3% and an 8% loan is probably pretty sizable, worth the wait.
Right.
So something to
Your
think about.
seller has to be willing to do that. That would be a caveat.
Right.
Well, if they're moving out of town because they got to take a new job, they're probably open to it.
Yeah, exactly.
So, I mean,
can I bring up one other brand new thing that just came out?
Sure.
We've got a brand new program under conventional loans where you can buy a multifamily home, a 2 to 4 unit property. If you're going to live in one of the units, it's considered owner occupied. It used to be you needed 15% down to get a conventional loan and buy a multi-unit property. They have changed that now where you can buy a multifamily 1 to 4 unit or 2 to 4 unit property with 5% down under the conventional financing program. So you can get into the world of investing. You can, if you're willing to live in one of the units, you can buy a multifamily property, live in a unit, rent out the other units. The rent that you acquire from those other units can also be used to help you qualify for the loan.
Okay.
So you can do a 5% down conventional multifamily 2 to 4 unit loan now. And it used to be you could only do an FHA loan under those scenarios. And sometimes the FHA didn't work well with those multifamily properties because maybe it had some peeling paint, maybe it needed a little bit of a fix up, and FHA wouldn't take that property. Where with conventional, it's a fantastic program. So 5% down, multifamily, conventional. If you're going to live in one of the units, that's the thing. You have to be living.
I will be
in the
giving
unit
you
as your primary residence.
I will be giving you a call about that product for myself.
Okay, great.
So thank you.
Happy to help you.
Yeah.
Yeah, it's a great deal.
All right, guys. I appreciate the information here this morning. If you like this information, want to see more of it, be sure to hit the like and subscribe and that notification bell as we produce more information like this. You'll be the first on the block to know it. I guess you could probably tell we've been doing this for a few years. We have a lot of experience. There's 1,000 different scenarios, and I won't say that I've done all 1,000 of them, but I've probably done 872 of them. And the other ones that I haven't done, we can get figured out pretty close for you. But the bottom line is the experience to get you from point A of wanting to buy a home to point B, which is sitting at the closing table and getting ready to move into your new home. There's a lot of different options. You're not just stuck with just one option, and you got to do that. One of the things you didn't mention here was USDA. You know, people that are living out, away from the city a little bit. And like where I live, I'm about 10 miles north of Powell, 10 miles south of Delaware, and I'm USDA here. And it goes right up. I mean, there's some streets just on the south end of Delaware, Ohio, that are USDA. So, and it's a no down payment program altogether with preferential rates and the whole bit. So, again, there's a lot of different scenarios, a lot of different ways to get you into the home that you want to be in. But it all starts with a phone call. So give us a call here at Sell for 1% or give Rich a call. His number is here on the screen. We'll be happy to help you, point you in the right direction, and get you into that new home. Thanks, guys, for joining us here this morning, and look forward to seeing you next week.